You probably think you own the S&P 500. Most investors do, but there are actually two versions of it. And in 2026, the one most people have never heard of is winning, not by a little, by a margin that should make every investor stop and pay attention. This week, new market data confirmed something that has been building all year. The equal weight S&P 500 is now outperforming the standard cap weight version, 11% versus 9% year to date. That gap does not sound dramatic on paper, but what's driving it reveals something important about where this market is actually heading. And if your portfolio is still built around the standard S&P 500, you may be on the wrong side of the biggest rotation in years. Let me explain what's actually happening here. When most people invest in the S&P 500, they buy something called the cap-weighted version. That means the biggest companies take up the most space. Apple, Microsoft, Nvidia, Amazon, Meta, they dominate. The top 10 companies make up nearly a third of the entire index. So when you put money in, most of it flows to the same handful of tech giants. Now here's where things get interesting. There is a second version of the S&P 500. It includes the exact same 500 companies, but it treats every single company equally. Apple gets the same weight as a regional bank. Nvidia gets the same weight as a healthcare company in Ohio. Every company gets roughly 0.2% of the portfolio. That is the equal weight S&P 500. And in 2026, that version is beating its famous counterpart. So why is this happening right now? To understand that, you have to look at what changed this year. For the last 2 years, the market was being carried by a small group of mega-cap tech companies. The AI excitement drove Nvidia, Microsoft, and Alphabet to extraordinary valuations. Those companies got bigger and bigger inside the cap weight index. The rest of the 500 companies got crowded out. But in 2026, something shifted. Tech started to slow down, not crash, not collapse, just breathe. And when the biggest companies paused, the rest of the market started moving. Financials started leading. Healthcare started gaining momentum. Defensive sectors that nobody talked about for 2 years started attracting serious money. Small cap stocks joined the rally. And because the equal weight index treats all 500 companies the same, it captured all of that momentum. The cap weight index barely felt it, because those smaller companies are buried underneath Apple and Nvidia in the standard version. Hold that thought, because the next part reveals exactly why this matters for your money personally. This week's market data also gave us an important signal about why this rotation may have room to run. May inflation data came in at 4.2% headline. That sounds alarming, but core inflation, which strips out energy and food, came in at 2.9%, below expectations. That is a meaningful distinction. It tells us that the inflation spike is largely coming from energy prices, and energy prices this week are falling fast. A potential US-Iran agreement is pushing oil prices sharply lower. If that deal holds, energy inflation fades, and if energy inflation fades, the Fed has more reason to stay patient. Markets responded immediately. The Dow hit fresh records, indexes closed higher. The broader market, not just tech, participated. That is exactly the environment where equal weight outperforms. When the rising tide lifts all 500 boats instead of just the 10 largest ones. If you are finding this useful, consider subscribing for more practical financial insights. Now let me bring this back to something concrete, because this is not just a market theory conversation. This has a direct impact on what you actually own. If you invest in a standard S&P 500 index fund, like the ones most 401k plans offer, you are heavily concentrated in a small number of mega-cap tech stocks. That has worked brilliantly for the last 2 years. But in a broadening market, that concentration becomes a drag. The equal weight version captures what the rest of the market is doing, and right now, the rest of the market is doing very well. Financials are gaining, healthcare is moving, small caps are outperforming, industrials are showing up. These are not flashy AI darlings. They are companies that power everyday life, banks processing transactions, hospitals treating patients, manufacturers building things, and in a broadening bull market, those companies earn their moment. Now, does this mean you should sell your standard S&P 500 fund tomorrow? No, that would be the wrong takeaway. But it does mean something worth thinking about. If your entire stock market exposure is through a cap-weighted index fund, you are systematically underweighting 490 companies every single day. You are betting that the 10 largest companies will always lead. Sometimes that bet wins. Right now, it is losing ground to a simpler idea. Treat every company equally and let the whole market compete. The equal weight S&P 500 is available to everyday investors through ETFs. The most widely used one tracks the same 500 companies. It has been around for years, but it rarely makes headlines because it rarely produces the dramatic single stock stories that drive clicks and conversation. It just quietly does what broad diversification is supposed to do. And in 2026, quietly is winning. There is another layer to this story that is easy to miss. The SpaceX IPO dominated headlines this week, the world's largest public offering ever, $75 billion raised. Elon Musk becoming the world's first trillionaire. It consumed enormous investor attention. But buried underneath all of that noise, the equal weight index outperformed again. While everyone was watching one company go public at a $1.8 trillion valuation, the other 499 companies in the index were doing real work, growing earnings, gaining institutional attention, attracting capital that was rotating out of stretched mega cap valuations. That is how wealth actually builds for most people. Not by catching the single biggest IPO of all time, but by owning a diversified slice of the economy when the economy is broadly healthy. And right now, the data says the economy is broadly healthy. Yes, headline inflation is elevated. Yes, the Fed is holding rates steady. Yes, there is geopolitical uncertainty around the Iran situation. But core inflation is softening. Oil prices are falling. 500 companies are participating in this rally. That combination does not guarantee anything. No market condition ever does. But it does suggest that the broadening we are seeing right now is not a one-week anomaly. It has been building all year. And the equal weight data is simply the clearest evidence of it. So here is what this week's market action is really telling you. The rally you are seeing is wider than the headlines suggest. The companies leading right now are not the ones getting the most attention. And the index most investors own may not be capturing the full picture. That is worth knowing. That is worth sitting with. The people who are paying attention to market breadth right now will look back on this moment differently than everyone else. Stay informed.